Right, welcome back to accounting. So now that we looked at the first 4 chapters, this is now looking into the different aspects of a business, right? And we're going to be focusing on inventory and how we purchase it and how we convert that into sales. Okay, so chapter 6 is sales. Okay. So let's take a look at what chapter 5 inventory actually looks like. Since I've mentioned to you before, right, we are looking at a merchandising type of business activity, right? Our main purpose is we must purchase inventory, and our goal here is to, make changes to it, right? Personalize it, customize it however we like, and then resell it for a higher price. Okay? So that means inventory is purchased for goods, okay, that have has the initial idea is we're going to take that product and we're going to resell it. So then inventory, okay, is going to be classified as something that we acquire, and when we buy it, right, when we buy our inventory, right, it becomes our property until the day that we sell it. Then we transfer ownership to the person who bought it. So in this case, we do classify this as a current asset because we own it, right? When we buy it, we own it, okay? And of course, when we're talking about converting this into a means, right? If we make purchase of it, then we're going to turn around and sell it, then we have to consider this, right? We have to consider that we're going to go make purchases of it, right? So we're going to use cash to buy the goods. Then we're going to take those goods and we're going to turn it into sales. And then once we turn those sales, right, we essentially are turning those sales into cash. So again, what kind of business usually does this? Any kind of retail store or any kind of wholesale store is typically going to have some kind of idea where we are going to make purchases of inventory, and our ultimate goal is to resell it out to the public. Okay? All right. So let's go ahead and talk about what is going to be considered the part of or the cost of purchasing inventory, okay? Because once we determine what the cost of inventory is, that's where we can determine what our selling price is, because selling price, right, must cover all costs of you getting the product plus a certain percentage of profit, right? In this case, what are all of those costs that could be included in the price of purchasing inventory? Well, the very, very, very first one is going to be obviously the price that you purchased the product at. Okay. Now, in this case, things that could affect it, that could increase the price, is sales tax, right? If you buy goods from a store and you have to be subject to pay sales tax for it, you should have the customers pay for the sales tax that you had to buy in order for you to get the items to your store. All right. And another thing could be any freight or shipping costs, shipping and handling, storage fees. Okay. So for those instances, right, you are not going to pay for the cost separately. Okay. But when we talk about it, they are separate expenses, right? Because if you really think about it, this shipping and handling is going to be something that you have to pay for those items to get to your store, right? But the idea here is, because you're trying to make a profit, you don't want to pocket out those costs, right, to buy your products, right? You want to try to calculate the entire cost, right, and then sell it to your customer to cover all the costs it takes for you to get those items to your store. Okay? So then these are the other expenses that could be potential for those extra costs that could be included as part of inventory, right? However, most cases, because if you are a legitimate business and you do go up to a manufacturer or a wholesaler, you could have the possibility to get tax exempt depending on what the situation is, okay? I'll give you an example. Costco. Costco used to have businesses be tax exempt, but now that they opened up Costco for anybody to have, right? You could be an executive membership, you could be a regular civilian, right? And you're able to obtain membership, so it's not strictly only for businesses anymore. So that's why they revoked the sales tax, right? They don't exempt tax for small business either, even if they have their own business Costco credit card. They don't it's sales tax exempt anymore, okay? So there are situations where things do unfortunately change, and that's where a business, right, will get charged sales tax. But like I said, most companies, if you can prove that you are a legitimate business and you're buying in bulk, oftentimes from business to business relationship, they do tax exempt you, okay? Because you're going to be collecting the sales tax for them anyway, all right? So that's just a little FYI. Now let's talk about shipping, okay? There are, a couple ways that we can understand shipping and how ownership is transferred from one person to another, okay? So in this case, right, we're talking about when we actually purchase our goods, when do those goods actually become our property? And how do we actually pay for those costs? Now, if you did not know, shipping is a two-part payment, right? You may pay $8.50 on your end, but they also have to pay $8.50 on their end too. So that's why shipping is going to be one of the most expensive costs it takes to get items shipped from one point to another, okay? And there are two types that you can do. We have FOB, which is freight on board. Usually that is that's just tacked on to your bill, right? When you get charged for shipping, it's just tacked onto the bill. Or you have the second option where it's called COD, which is cash on delivery, where the big manufacturing companies, they get a third-party vendor to deliver those items to you, right? And because they're paying their third-party vendor to ship these items to you, you have to pay your end when you receive it, okay? Hence the word cash on delivery. So yes, these two are the most widely common ones that you do see, okay? But let's go ahead and talk about how it gets transferred from ownership and who pays for what, okay? So let's start with FOB shipping point. This is where it is from the seller's store and it's making its way to the buyer, okay? And here's a midway point. This midway point, right, this portion right here is where the buyer is responsible to pay for the shipping because they're asking the seller to ship the items to their store. So in this case, who is responsible for the items at this point? FOB shipping point is the buyer is responsible to pay for the shipping from the selling point to the midway point. Okay? Why is that? But at this point, right, the items are still in the seller's possession. It is still the seller's items, right? They haven't transferred ownership yet. Okay? So that's where you have to understand. Now, from the midway point all the way up to FOB destination, now it is the seller's responsibility to pay for the shipping and they are responsible for anything that happens to those items. So therefore, the midway point to the buyer's store, right? The seller is responsible for anything that happens there. So for instance, right, Amazon, right? You buy something on Amazon, you pay for shipping, you're done deal, right? And it says it's going to ship here in 2 days. That's the same idea here, right? You paid the seller money and you paid for the shipping, right? And the taxes and everything to get from the seller store to the midway point. Now, once it gets from the midway point to the buyer's store, right? This is where Amazon always gets the most trouble because, again, depending on who the delivery services is, usually they do FedEx, UPS, and they have their own Amazon trucks now. Sometimes the packages doesn't get there. And what happens from there, from the midway point to the buyer's store? The seller is still responsible because they're paying for the shipping. They are also responsible for anything that happens. So that's why if you don't receive your package, you call up the vendor and say, hey, I didn't receive my package. So therefore, the seller is responsible to, either send out a new one, refund the money, etc., etc. Okay? All right? Is that, does any questions here?
I just have a comment.
Mm-hmm.
About a week ago, I ordered from Amazon a under desk tray to set my keyboard on, and I received it. The parts were not put together, and I couldn't do it because there were no instructions. And so I contacted the seller, and they said they had nothing to do with it, that I needed to contact Amazon. So, but it was their responsibility, right?
Correct. So that means they have to give you either a refund. Most cases, they don't ship new items anymore. You have to actually request for a refund. Now, in this case, Amazon also hosts a bunch of other companies as well too. So it could be not just Amazon is just the platform that you buy it on, but underneath the Amazon, right, there's a bunch of store owners that has their own little shop that they're responsible to ship the items out to you. So that could be a situation where Amazon is just the place that you bought it on, but the person that you bought it through was an actual particular vendor. So that's a situation that, yes, Amazon, they do ship it to you, but that's a thing because it's Amazon's name. They're the ones who sold you the product because it's their platform that they're using. If it's the vendor's mistake, then they have to be contacted, or it tells you to contact that vendor, right? And request for a refund. Yes. In this case, there's a lot of things that Amazon is, but it used to be their products only, or they, but now that Amazon's becoming so big that they hold other vendors and other store owners on there, that it's not always going to be Amazon's fault, but it is going to also be, when you buy something on Amazon, you're looking at Amazon's name, not the whoever sold you the product. Okay? So in this case, for that kind of reason, yeah, you are going to have to request a refund, or you're going to, again, because it is the seller's responsibility. However, when the middle point gets to your store, right, that item becomes your property. Okay? So that keyboard tray that you have, it's yours now. What do you do with it is what's going to come next, right? Are you going to return it? Are you going to have to do this? And then sometimes, right, they'll even charge you shipping because you have to pay the shipping to send it back. Yada, yada, yada.
Well, I did return it, and it didn't cost me anything.
Good, yeah. All right, so that's the situation here. All right, any other questions? So let's go ahead and talk about inventory tracking methods. What are they? Okay. So there are two ways that you can keep track of your inventory, right? We have periodic and we have perpetual. Okay. Periodic is straightforward, right? As far as we talk about definition wise, it is exactly what is defined, right? Periodically, right, means every once in a while or occasionally, right? And that's the same, that's the aspect that is applied to this type of tracking method is you don't really care to keep track of buying your items and selling them, right? You don't keep a huge track record of how many items you have on inventory on hand at all times, right? Maybe because the item that you buy isn't something you sell as often. So if it's a product that I don't sell as often and I know for sure that a customer would come in, they wouldn't buy it because it's not something that they want. But maybe there's other products that they do want that does sell more often, right? So in this case, right, there's no real need to keep a really good track record of it if you know it's an item that doesn't clear off your shelf as often, right? So in this case, right, that's why you would use periodic inventory because you don't necessarily need to keep a really good track record, and the way that you would do it is at the end of the accounting period, you do need to go down to the physical warehouse or wherever you keep your inventory and do an inventory count, right? Just because if it's something that you don't sell very often, it's still good to at least keep your numbers in check by going downstairs to the basement and taking a physical count. Okay? And in this case, then you'll know whether you are missing something or you sold something, and so on and so forth. Because if you purchased it, then you know how many you purchased, because that's going to be a record you're going to be keeping, right? But however, when you take a physical count, then you're going to either match up the numbers that you have in your books, where you're matching how much you purchased, or at the end of the day, your assumption is you must have either sold it, got rid of it, did something to that product, okay? And here's a huge difference between periodic and perpetual, right? All purchases are going to be recorded as expenses, okay? Now, and then once you record them as expenses, you are required to have a conversion entry that allows you to convert the expenses into inventory at the end of the giving accounting period. So in this case, right, if you briefly remember chapter 4, right, we talked about adjustments. Periodic inventory is 100% in adjustment because it is always done at the end of a giving accounting period, okay? Now, again, you don't necessarily have to do it at the end of the giving accounting period. If you want to do it at the end of every week, that is okay as well, especially because it's inventory. But however, you definitely want to make sure that you do journalize your transactions at the end of the giving accounting period. You don't usually do it in between the middle, but you can always take a physical count, usually between weeks or between whatever your giving accounting period is. Okay, so if you need to take a daily check, go ahead and do it, right? However, you don't compute the conversion entry until the end of the given accounting period. Okay? So again, when we make our purchases of inventory, we recognize them as expenses. And then when we reach the end of the accounting period, we have someone to go down to take a physical count. That's going to determine to us what our ending balance is in our inventory, right? How many units we have left. And that's going to also determine how many items we sold, because that's the assumption. And once we've done that, then we can convert our expenses into inventory at the end of the giving accounting period. Okay? Whereas perpetual, right, Perpetual literally means constantly. If you defined it, it means constantly because you're constantly updating your inventory at any given time where you make a purchase, and when you sell your items, you're keeping a really close track record. So in this case, when you are constantly updating your inventory, you're going to always know the actual amount of items you should have in inventory at all times, whether it's every day, every week, every 2 weeks, every month. Okay, because you're keeping such a good track record. Every time you make a purchase, you add your inventory. Every time you sell your items, you subtract your inventory. Okay, so therefore, you should have an idea of how many items you have on inventory at all times. So, in this case, right, think of it like when you go to a clothing store, right? They, again, with technology, everything makes keeping track of inventory a lot more easily. So again, you can just simply scan the barcode and they can tell you how much they have in stock at all times, right? And every time you sell something, the system will subtract it out immediately. So then when you do run that, scan to check if you have those items available, you will know if it will have it because it will show up for you. So that's a good example of perpetual inventory, is that, again, you're going to constantly know exactly how many items you have on hand at all times. And here's the difference between periodic and perpetual. Everything is going to go straight into inventory. Okay? You're not going to recognize it as an expense. You're going to recognize it as inventory and inventory only. And everything is going to be dropped into inventory. Okay? Now, for chapter 5 and chapter 6, we are going to be focusing on one of these tracking methods first. Chapter 7 and 8, we will deal with the other one later. So for chapter 5 and 6, we're going to deal with periodic inventory first, so we can kind of understand what is the motions, what is it like to use periodic inventory, and then chapter 7 and 8 is where I split it up, and that's where you'll find out what it means to have perpetual inventory. Okay? So that means for this exam, I need you to know that there are two tracking methods and what the differences are. However, the chapter 5 and 6, we're going to be dealing with periodic purchases and periodic sales. So let's go ahead and dive right into periodic inventory. Okay. So first, let's talk about how we actually purchase our inventory, right? As I briefly mentioned to you before, right, we're going to have this kind of scenario where we're going to analyze, right, use our 7 steps of transaction analysis to determine what our goal and what our means to properly record a transaction, especially when we purchase inventory, because again, I'm going to be introducing you to inventory worksheets. Okay? So in this case right here for the example, on July 1st, XYZ company purchased 100 units of toys from Toys U. Okay? All right? And it cost me $5.65 each. Okay? The freight costs totaled up of $100. Okay? And purchase was made on an account. Okay? So let's go ahead and record this transaction. So here, for the sake of this class and this class only, I'm only going to show you 2 accounts: purchase expense and freight expense, okay? I'm not going to throw in any other expense because, again, those can be applicable, right? Sales tax is not always, right? Foreign costs or storage fees are not always, right? But usually typical thing that you would see would be freight, which is another word for shipping, okay? And obviously what the original purchase price was. Okay? So let's go ahead and dive in. So we need to analyze the situation because this 100% affects our business, right? We acquired inventory. We acquired an asset. But how did we pay for it? Well, we paid it for it on an account. In this case, right? If we didn't pay for it, but we were able to purchase it on an account, therefore, we need to recognize that anything that's on the word account is going to refer to as an accounts payable, okay? Right, we owe money. Now, as mentioned before, right, we have a purchase expense account and we have a freight expense account. Now, in this case, my purchase expense account, right, since we made a purchase of 100 toys, right? How much did it cost me? It cost me $5.65 per item. So $5.65 times 100 gives you $565. Okay? Freight cost, as we know, right, is actually separated then from actually buying the actual product from the vendor, right? This is your cost that you have to pay for to get the items to your store. Okay, so this is going to be considered an extra or an additional cost it takes for you to get your inventory up to your store. So in this case, freight cost was $100. So I'm going to list it right there under freight expense. And because I owe it on an account, I'm going to recognize I owe money. So I'm going to recognize an accounts payable, and it's going to be for the grand total amount of $665. Okay? So one of them is keeping our purchases expense separate from our freight expense. Okay? So for any other extra costs that you have to pay for, they're all going to be considered separate expenses. Okay? Any questions here?
No.
Okay. Now that was the first part, right? Just recording a purchase. It's pretty straightforward, right? As long as you can recognize what the purchase expense is, what the freight expense is, and how did you pay for it, okay? Now, of course, when we make purchases of inventory, we have to consider what discounts are available to when we actually make our purchases, because that's what we should be looking for, is what are the opportunities that I can take an advantage if I'm buying stuff, I want to buy them at the lowest cost possible. So this is where I'm going to be introducing you to terms, okay? Terms is a means for any reason that, you purchase or sell an item, right? Terms are going to be considered incentives to get paid back sooner than later, okay? Especially when you are looking into a customer to vendor relationship, right? If you're buying from somebody, right, they're gonna want to expect you to pay off your bill a lot sooner, especially if you're going to be potentially buying in bulk. And again, if you buy in bulk, then that means the money dollar value is a lot higher, right? So they throw in an incentive to give you a discount if you pay them back quicker than later. Because again, the quicker you pay them, the more opportunity that they can go and create their products, okay? So in this case, they give us terms. What does 2% 15 net 30 mean? Well, 2% means, okay, so in this terms, right, this means that I will give you a 2% discount if you pay within 15 days, okay? If not, the whole bill is due within 30 days, okay? So, of course, 15 days is going to be the first 15 days. And then after, it's not after the 15 days, it's an extra 30. No, you have the 30 months. But if you pay within the first 15 days, then you'll receive a discount, a 2% discount. But at the end of the day, usually, if you remember that rule right, most vendors usually give 30, 60, 90 days policy. Okay? So in this case, it gives you 30 days to pay them back. But they say that if you pay within the first 15 days, we'll go ahead and give you a discount. If not, the entire bill is in due within the 30 days. Okay? So when we talk about terms, because the vendors usually will be giving incentives, especially to you because you are a purchaser, right? So they're going to try to entice you with opportunities for you to pay them sooner, so then they can give you they can grant you a discounted price on the products that you buy, right? Now, depending on what your financial stability is, when it comes to what your company is, will determine whether you use the net method or the gross method, okay? The net method, right, usually means that when you are given a discount, right, you're going to assume that you're very good at paying your bills, right, and that you have the sufficient funds to pay for those, the bills off on time, right? And you're going to be really good at paying it within the discount due date. So when you purchase things, usually you typically pay it within a couple of days. That is fine. Usually for companies that have a large bank account can typically take advantage of those discounts, right? So then what you're going to do is, instead of recording it at full price, you're going to be assuming that you're going to record it at the discounted price, okay? So the net method is when you take the discount immediately, okay? Gross method is where you're not quite sure when you would have the sufficient funds to be able to make the payments. Again, maybe you're too small of a business, maybe you're a startup company and you're trying to build your brand up, and you're struggling with paying with other bills on time. So in this kind of idea, right, things are gonna be more in priority, right? Maybe paying your employees is more important than paying for items of inventory and getting a discount. So for the gross method, right, you record it at original price until the day that you do actually pay for it. You determine whether you receive the discount or not, okay? So in this kind of case, this is where it's the gross method, where you don't determine the discount until you pay. Where the first one is, you will take the discount beforehand so you can save yourself an extra journal, right? And you just pay your vendor accordingly, okay? Now, a great way to understand net and gross is straightforward, especially when you apply it to looking at your own paycheck, right? Gross meaning what you earned completely, right? And then net is going to be taking out all of your taxes, and that's how much money that you get at the end of the day. So that's similar to this idea too, where are you going to record what you've earned and then wait till payday, then you take your taxes out? Or for the net method, you record it when you record it as taking all your taxes out right then and there. Okay, so that's the same idea here. Now let's go ahead and apply it to an actual scenario so we can kind of see and understand how this works. So for example here, right, on February 1st, you purchase 100 coffee mugs from Cuppy's Co., right? And each coffee mug costs you $1.25. Freight was $100, okay? And the vendor gave you terms of 5% if you pay within 10 days. If not, the bill is due in 30 days, okay? So we're assuming we bought this on an account, and record this transaction using the periodic inventory method. Okay? So in this case, what we're going to do is right now, terms, okay? Terms is they'll give me 5% if I pay within 10 days. So that means I got to look at the date that I bought it. Or usually you're going to be looking at the date that you actually received the inventory along with the bill, because this is based on the billing date. It's 10 days after the billing date. So in this case, if I receive my items and receive the bill on February 1st, then I have 10 days to pay it. So that means I'm expecting by February 10, or in this case, February 11, because it's 10 days after. So the 1st, it's already the 1st, so plus 10 gives you February 11. You have until February 11th to pay for this bill to receive the 5% discount. If not, then you have until March 2nd to pay for the entire bill itself. So let's go ahead and recognize using the gross method is we're going to record it at original price. So in this case, purchase expense, freight expense, okay? So the purchase expense was $125 because it was $1.25 per item, okay? And then we recognize the freight as separate. That gives us 100, okay? And then now the accounts payable is going to be $225, okay? This is the gross method. We're recording it at original price, okay? Because our assumption is we're not paying them yet, okay? So then scenario 1, let's say the situation was, it's now February 9, and we decide to pay the amount that we owe to Cuppies Co., okay? And because we paid on the 9th, right? We said that if we paid within February 11, then we would receive the discount. So in this case, we made the discount due date, right? Because we paid on February 9th. So how do I record that I received the discount? Well, in this case, right, we first need to recognize how much we owe. In this case, we owe $225 because that's what I originally journalized it at. But because I'm making a payment as of February 9, I'm not paying $225. I'm going to be paying the discounted amount because I paid within terms. So in this case, what I got to do is I got to create a contra account called purchase discounts. Okay? So again, purchase discounts, it reduces your original one, which is your purchase expense. So in this case, it flows in the opposite direction, right? Because if you remember, purchase expense is debited. So in this case, a purchase discount is going to decrease my purchase expense, right? And it's going to be on the credit side. Now, how do I determine the discount? Well, in this case, there's only one thing that you can discount, okay? You can only discount the original purchase price that you purchased the items for. So in this case, I purchased the items at $1.25 each, right? So if I purchased 100 of them, then it's $125, and I can only take a discount off of the $125, okay? Now think of it in reality, right? Do you think I can take a discount off of shipping? Is it possible to take off a discount for shipping?
No?
No. If you go to UPS or any FedEx store, right, can you go up to them and say, "Can I get a discount?"
No.
No, they're going to laugh at you because that's not how UPS works, right? You're paying for the price of sending something to somebody. So therefore, they look at the size of the box and they look at how heavy the box is. They don't care. You can't be asking for discounts at all. There's never an occasion where you go to UPS and they said, "Hey, send in your packages now and you can take a 5% discount." No. UPS will never have that kind of sale, or they're not that kind of service, right? Their only thing is you're paying them to send you an item from one place to another. That is it. So whatever price it comes out to be is whatever price it comes out to be. So you can't even discount shipping, right? And this is the money that you paid their vendor to ship the items out to you. So they can't give you that money back. So in this case, you cannot discount shipping. Now think about it for sales tax. Do you think you can discount sales tax?
No.
Absolutely not, right? Because sales tax belongs to the local and state governments, right? So in this case, no, you can never discount sales tax. So in this case, what can I discount? You're only allowed to discount the actual purchase price of the products that you are purchasing. So this 5% discount can only be applied to the purchase expense itself. Okay? So in this case, whatever 5% of 125 is, which you give $6.25. So therefore, that's going to be discounted off of you because you're not going to pay for full price because you paid within terms. So in this case, you're going to write a check for $218.75. Okay? And on their end, because they gave you those terms, right, they have to, again, once they retrieve the check, they have to understand that is correct. Since they're so good at keeping track of their records, right, that they paid me based on a discount, then I don't have to calculate the discount myself. Now, usually, the discount due date should be on the invoice itself. Okay. So there you go. All right. You paid only $218.75 because you paid within terms. Okay. Now, let's say scenario 2, right? So ignore what happened in the first scenario, right? And let's say you purchase everything on February 1st. So now, fast forward, it's February 15th, and you decide to pay Cuppy's Co. for your purchases, okay? And terms were 5% 15, net 30, or 5% 10, net 30. In this case, I missed my discount due date because my discount due date, right? I figured it out to be on February 11. So in this case, I already missed it because I'm paying them on February 15. But however, I am still paying within the actual billing due date, right? Which is 30 days, right? They gave me 30 days to pay for it. I'm still paying within there, so I won't be charged any late fees. However, I missed the opportunity to take a discount, okay? So how would I record that I paid this? Straightforward, right? I pay them for what I owe for the $225 because I missed the discount. I missed the opportunity for the discount. So in this case, that is a gross method where you're on a condition. If you pay, then you record whether you received the discount or not. Okay? Right? Any questions here?
No.
So then let's talk about the difference between the gross and the net method. Well, in this case, as we know, net method means you're going to take the discount out immediately, right? So in the case, the same scenario, February 1st, you purchase 100 coffee mugs from Cuppy's Co. on an account, and you purchase them for $1.25 each. Rate was $100, and terms were 5% 10, net 30. Record this transaction using the periodic inventory. So in this case, right, since I am going to be using the net method, and we're just going to assume, well, you know what, I'm going to record these items at the discounted price, okay? So in this case, I'm already going to calculate the discount even before paying, okay? So that's the huge difference here because you're already using the net method where you're subtracting everything out and you're going to assume what you should owe, okay? So in this case, purchase expense, freight expense, and your accounts payable. So in this case, I'm going to take the discount immediately. I'm going to say, well, I purchased it for $125, right? Minus the discount, which is $6.25. So therefore, I should owe $118, okay? Plus the freight of $100, right? You can't take discount off of freight. So it's going to be tacked on as a separate, it's tacked on as a separate cost. So in this case, I only owe $218.75, okay? So again, this is to essentially save you another journal to record the discount, okay? Because let's say then scenario 1, I choose to pay on February 9, right? Which we already know I paid within the discount due date. So therefore, I don't even recognize the discount at all because I already recognized it in the very beginning. Right? I assumed that when I buy my stuff, they're already discounted because I'm going to say I will pay within the discount due date, or I'll pay within the whatever the discount due date was. Okay? Now, if you are in a business where you have a billion different inventories that you purchase left and right, this is going to be a lot harder. But again, usually if you have the money, right, you can make the purchase, and if they give you those terms, you can pay it off the next day. Now, if you are looking at a struggling kind of business, this might not be the case, right? We might not be able to afford our inventory right as of now, but we can, because we have to pay for other stuff like rent, and our employees are definitely way more important. Then you can go ahead, and then if you have the sufficient funds within those 30 days, you pay for the bill then. In this case, we're assuming we're very good at paying our bills. We got the money, so we're going to assume we're going to take the discount automatically, and then we just pay them for what we assume that we owe. Okay? But that doesn't reflect what your bill says, because your bill says that you owe $225. I'm making the assumption that this is what I should be owing. Okay? So that's that there. Now, what if one day I accidentally forgot and I end up paying on the 15th? What's going to happen there? Because now I already recorded the price at discounted price. So what do I actually have to do? So in this case, right, I end up having to make a contra account. Okay? So this is a contra account. Two contras. So again, if one contra is in the opposite direction, two contras is going to flip it again back to the same side. So in this case, debit, right? One contra is making it a credit. Second contra is going to make it back to a debit. So that's exactly what I have to do, is I have to create a contra account. So this is a contra account that is directly correlated to the purchase discount, except this time I'm recognizing it as a purchase discount loss because in the very beginning, right, I recognized it as a discounted price. I did not recognize what the bill told me it was equal to, because I want to use the net method. So in this case, I end up losing the opportunity to take $6.25 off. So right there, I lost the, purchasing, 3 coffee mugs, right? So in this case, there you go. That's what you have to do. You're going to have to recognize that I have a purchase discount loss, and I end up having to pay for the full amount of the $225. Okay? So again, this is on your books, not their books, okay? They don't know what you record their stuff at. They don't know what you do with their products, okay? This is your books, okay? So in this case, I recorded it that I wanted them at a discount, but I end up missing that discount period, so therefore I need to correct my entry by placing in a contra account to reflect the opportunity that I missed out on. Okay? So therefore, I have to pay for it full price of $225. Okay. Any questions here?
Nope.
Okay. Chapter review. So we talked about periodic and perpetual inventory, right? Those are the two tracking methods for inventory. Okay. We talked about shipping, right? From the seller store to the midway point to the buyer store, who's responsible? Okay, shipping point, the buyer's responsible. Okay, shipping destination, the seller's responsible. Okay, we talked about FOB, which is freight on board, and we talked about COD, which is cash on delivery. Okay, and we also talked about what is an example of how you would journalize a purchase of inventory. Okay, so there you go, purchase expense, freight expense, and however you paid for it. Okay. We talked about the two different methods of when we actually receive discounts, right? We have terms, which we understand as it's an incentive for vendors to give to us buyers as a way to get their money quicker, right? But also to cut, and the idea here is to also give opportunities for a discount by giving the incentive, right? If you can pay me back, if you can pay me quicker, then I'll gratify you with giving you a discount. Okay? We learn about the net method versus the gross method. Okay? Okay? So, let's go ahead and dive right into the chapter 5.1 exercises. Okay? So, taking a look here, number 1, journalize and assume all purchases were made with cash. Okay? And you can also assume that sales taxes, no sales taxes, sorry. So this case, right, April 5th, we purchased 1,000 units at $5 each with the freight costing $100, okay? And we are assuming that all purchases were made with cash. So how do I properly journalize this transaction? It's April 5th.
Purchase expense.
Okay? For how much? $5,000, right? Remember, the monetary assumption, it has to be in terms of dollar value, not quantity.
And freight expense.
Freight expense, good. For how much?
$100.
Right? And how did we pay?
Accounts payable.
Let's try again. Assume that all purchases were made with cash. Good. So in this case, we paid with cash. So how much did we pay? $5,100. So this is where you could also practice your descriptions as well, right? You could say that in parentheses, I purchased 1,000 units at $5 each. Okay? Right? Because you don't need to say shipping was $100 because it's straightforward, right? Freight expense was $100. Okay? Alright? So let's practice with the second one. April 10, I end up purchasing 750 units at $5.75 each. Freight was $75.
Okay. Purchase expense.
Mm-hmm. So the great thing about technology is you do have the ability to copy and paste. Okay, purchase expense, freight expense, we paid with cash. So in this case, how much was my total purchase expense?
$4,312.5.50.
3,001, what was it? Four,
$4,312.50.
okay. How much was my freight?
75.
75. So then what's my total cash that I paid?
$4,387.50.
Good. And again, you could practice your description, right? As long as it's in parentheses, right? We said we purchased 750 units at, what was at $5.75 each. Okay. Right, next one, right? We made a purchase on April 20th, right? We purchased 200 units at $6 each. Freight was $20. So in this case, April 20th, copy and paste. Okay, so that's the great thing about technology, and you guys are here to learn how to use technology. So in this case, yes, you can copy and paste your transactions. Nothing wrong with that. Okay. So, what should be my purchase expense and my freight expense? If I bought 200 units at $6 each,
1,200.
how much is my freight? $20. So in grand total, how much did I pay? $12.20. Good. Right? Practice making my note here. Purchased 200 units at $6 each. Okay. Last question here, or last journal here, is April 25th. We purchased 500 units at $6.25 each, freight costing $50. So in this case, April 25th, okay. If I bought 500 units at $6.25 each, what's my total purchase price?
3,125.
Okay, plus $50 freight. 3,175. Good, right? And then, right, I purchased 500 units at $6.25 each. Okay. So again, every transaction or every transaction that you're complete done with, you skip a line. Okay. And it should look like this. Okay. All right, question number 2. What costs are included when making a purchase for inventory? Sales tax, okay. What was that?
Shipping.
Shipping. What else? What's the main one that you have to pay for?
Your purchase.
Yep, your purchase price. Okay. To sum it all up, it's going to be all cost to get your asset to your store. Okay. That's a key word, to get the items to your store. Okay. Question number 3. Okay. What are the 2 tracking methods for inventory?
Periodic.
Okay. And starts with the same 3 first letters.
I can't think of it.
Okay, so let's take a visit to the perpetual. Yes, perpetual. Okay. All right, number 4. What does net method mean? Yeah, good, right? Taking the discount out immediately. So take discount immediately. Okay. Number 5, using the gross method and periodic inventory. If you made a purchase on April 5th, okay, which was the 1,000 toys at $5 each, with the freight costing $100 on an account, okay, and the vendor gives you terms of 5%, 15, net 30. Journalize this transaction, okay? Once again, if you're using the gross method. So how would we journalize this? Using the gross method.
Is it accounts payable?
It is accounts payable.
Purchase expense.
Right? We got the freight.
Okay. Great.
And then this time, instead of putting cash, we do use the accounts payable, right?
Okay.
Now, in this case, what was my purchase price? $5,000, because we're using the gross method, right? We're not taking the discount yet. We're gonna wait till we pay. All right, and then the freight, $100, which will give us a total of $5,100. All right, and then of course you can make your little description here saying you purchased 1,000 units at $5 each, comma, and say what your terms were. They will give me 5% discount if I pay within 15 days. If not, it is due in 30. Okay. So then 6 says continue from question 5 and you end up paying the vendor on April 15. Journalize this discount. So in this case, right, I bought it on April 5th and I have 15 days to get a 5% discount. So that means I have to pay by April 20th, okay? But in this case, I end up paying on April 15th. So how do I record the discount? I'm making a payment to what I owe, and I need to recognize the discount.
Purchase expense.
No, you already got the items already.
Okay, accounts payable.
Accounts payable, right? You got to recognize what you owe. Good. Now, how much do you owe right now? And this is a continuation for question 5.
5,100.
You owe $5,100. Okay. Now, am I gonna pay $5,100?
No.
No. Okay. So I'm assuming I'm gonna pay with a check. Right. What else do I need to recognize?
The discount.
I need to recognize the discount. Now, what do I call that account? Right? Purchase discount, because I got the discount. So in this case, right, I'm going to be receiving a 5% discount. Now, what amount can I discount? What number can I use to discount? How much is going to be a 5% discount?
5,000.
5,000, right? So in this case, what is 5% of 5,000? You said 250? Yeah, good. Right? That means you get a $250 discount. So in this case, how much are you going to actually pay?
Uh, 4,650.
Not 650. Not 4,950. You forgot something else. Okay, so if I took $250 from my 5,000, how much is that? Sorry, what did you say? 4,850? Yes, that's correct. Because in this case, right, if I'm taking the discount off of 5,000, right? So 250 minus 5,000 gives me 4,750. But I also have to include that I'm paying for the freight too, right? So I got to tack in an extra $100 to give me 4,850. Now the easiest way to do this is just taking your total amount of what you owe of 5,100 and simply just subtracting out 250, and you should get 4,850. Good. Now again, you could say paid for purchases on April 5th, right? Received 5% discount. Right? All right. Number 7, using the information from question 5, journalize the purchase using the net method. Okay, so let me push this down to the next page. Okay. So again, we're going to be using the net method. Okay, so using the information from above, from question 5, so we purchased 100 units for $5, 1,000 units for $5 each, with the freight costing $100 on an account. Terms were 5%, 15, net 30. So how do I record that? Using the net method.
Accounts payable.
Not accounts payable. Oh, I mean, that is going to be one of the accounts. What else are we going to recognize?
Purchase expense.
Yes. We're going to recognize a purchase expense. And we're going to recognize freight. Okay? Okay? If I'm using the net method, right? $4,750 for purchase plus 100 is going to give me $4,850. Okay? And that's what I should owe, right? Not what they billed me. That's what, because it's the net method, we're saying that we're going to pay them on time. So this is the amount that I should be owing. Right? Right? And then last question of the day, or sorry, last question of this worksheet here. What does terms mean if 2% 10 net 30? What does this term mean? 2% 10 net 20.
For any reason you purchase or sell items are incentives.
That's what the definition of terms mean. But my question is, if I gave you a terms of 2% 10 net 20, go ahead.
If you pay within 10 days, you get 2% off.
Mm-hmm.
I thought that was the
Okay. If not,
You have to pay the whole thing by 20 days, right?
correct. Correct. So in this case, if you pay within 10 days, you will take 2% discount. If not, you will have to pay in full within 20 days. Good. All right. Any questions for chapter 5.1?